What if I told you that the biggest potential investment opportunities in 2025 might not be in those flashy AI stocks, the latest tech companies that everyone's talking about? What if they're actually hiding in some of the most boring and overlooked places you can imagine? So today, I want to share these 3 areas where I think that there might be real opportunities in 2025. Not because they're trendy right now, but because they're undervalued, in my opinion, and when the market does take notice, they will become the trend. I'm talking about gold miners, oil companies, steel manufacturers, and smaller businesses that no one seems to focus on. Now, I'm not promising that you're going to get rich quick. Quite the opposite. That's not what investing is about. But I'm going to show you where the smart money could start shifting towards and why the difference between price and value could bring huge opportunities. Because remember, in investing, and if you're new to investing, it's really important you understand this. Our goal is to buy when price is below value. The market is going to misprice things very regularly. If you can wait for that opportunity, but more important, understand what the value is, which we'll get into, that's where you make the big bucks. So if this is your first time seeing our channel, you're in the right place. Because if you scour YouTube, honestly, you're not going to find many people talking about investments the way we do. This isn't some generic video. I'm sharing a specific, principle-driven investing approach based on real data and decades of experience. Now, one thing I want to say, you probably saw the title and said, this is awesome. And I do think these 3 ideas have amazing opportunities. But the great part is, not just for 2025. As long as they're undervalued, eventually the market will take notice. So, opportunity number 1. Now, before you roll your eyes and think gold is for the preppers, hear me out and I'm going to share a little history. For thousands of years, gold has been trusted as money. This isn't just a 10 or 15 year long history. We're talking thousands and thousands of years. Empires would mint gold coins. People used it for trade, and central banks still hold gold as reserves. Now, of course, they don't attach their money to gold, but the point is it's still there as reserves. Unlike paper currency, gold cannot be printed. Its supply grows slowly, which helps preserve its value. Gold doesn't pay dividends like stocks do, and it doesn't grow like a tech company might. But it does something that's really, really important. When inflation heats up, history shows that people will buy gold to protect themselves from losing purchasing power. And here's what's even more interesting. Countries like China and Russia have been buying massive amounts of gold lately. Why? Because they want people to trust their currency even more. And gold has been trusted as valuable for thousands and thousands of years. So when central banks and governments buy gold, they help support its price. That's what makes gold miners, companies that extract gold from the earth, interesting investments. They benefit directly from rising gold prices. Now, I want you guys to know something. Gold in and of itself, in my opinion, is not an investment. It is speculation. Because if I owned a bar of gold and all of a sudden the market for that gold goes away, yes, I'd still have some value being able to trade. But that gold is not going to give me any sort of return on my money directly right now. But that's why I buy gold miners. And guys, I've been owning gold miners. You can check our channel in the past since gold was around $1,500 to $1,600 per ounce. And people were a little skeptical of that. But the reason being is I have seen, I'll get later on in this video, I've seen that when markets are overpriced and there's a potential lost decade ahead, gold does very well. Think of precious metals like gold as insurance for your portfolio. You're not buying gold because you think it's going to double overnight. You're buying it because when people lose confidence in paper money or in the stock market, gold tends to do very well. Now, guys, like I said, gold has multiple uses. I mean, you don't sit there and just use it for currency. Guess what? All of you out there, if you're male, your girlfriends and your wives love gold. If you're female, you love gold. If you're me, you like gold. I buy watches, and of course, I pay more money for the ones that have gold in them. Spoiler alert, I don't pay more money for the ones that have Bitcoin in them, but I'll get to that some other video. Keep in mind, as I said before, I do not own gold itself. For me, physical gold feels more like a shiny rock with no income. It's not productive. That's for me. Instead, I invest in the gold miners ETF. And I'm going to repeat till I'm blue in the face. This is not something that you should just go do because somebody on the internet has. If you're new to the channel, I will speak about that over and over again. But these funds own companies that take gold out of the ground, process it, and sell it. And when gold prices rise, miners' profits usually rise even faster because their costs are staying a little bit more stable. Gold miner ETFs give you exposure to the gold price plus leverage through their operations. Now, I have GDX and GDXJ. These are large and small gold miners. When I bought them years ago, the cost to take gold out of the ground, meaning the whole thing, was about $900 an ounce, and gold was selling for about $1,500, $1,600. Now, gold is at $3,700 an ounce, and guess what? Those costs are only up to $1,400 or $1,500. This is the largest margin in history. So that is why I own those. And it's been a slow grind for a while, but it's just as of late taking notice. But one thing I want you to see, when the stock market is flat, gold does well. As you can see here, we've had several lost decades where secular bear markets occur, and look at the comparison to gold. Another potential opportunity in commodities. This one's really simple when you think about it. The world runs on stuff. Oil to power our cars. Oil to put in our stuff. People don't realize your plastics, all your goods have oil in them. Copper for electrical wires, steel for buildings, and lumber for houses. Commodities in general, as a percentage of the S&P 500, have never been cheaper. We've been cheap for a long time, and the businesses within these sectors have right-sized their balance sheets, and they've consolidated the industries they're in through mergers and acquisitions. When there's consolidation, there's more efficiency. When there's more efficiency, there's less costs. When there's less costs, there is more profit. And it takes some time for the markets to realize this. But guess what? They will eventually. So guys, when it comes to commodities, if every extra unit they create of oil, of copper, is easy to get, what's going to happen to prices? They're going to fall. Because if it's easy to get, they're going to bring a lot of it to market. Think about it this way, as I always joke. My father's a physician. And he would say to me, Paul, I save people's lives. It's not right that basketball players go out there, put a ball through the hoop, and they make a ton of money. I'm like, great, then go put a ball through the hoop. Well, I can't. Yeah, because it's really effing hard. Becoming a doctor is hard as well, too. But there are 650,000 active doctors in the United States at any given moment. And in the history of the NBA, only 5,000 people have ever been on the court actively. Not even worn a uniform, just been on the court. Supply and demand. So the same thing with these commodities. When it's really easy to bring it to market, prices fall. This applies to natural gas, applies to oil, applies to steel, applies to copper, cement. I could keep on going. And here's what's happening. These commodity companies' supplies are getting much tighter. So it's getting harder and more expensive to find new sources. So if you can't find new sources, the supply goes down. When the supply goes down, what happens to price? Price goes up. So guys, that's the supply part. If supply is harder, prices go up. But even on the demand side, demand for commodities is steadily growing. Guys, think about the world. I'm in the US. A lot of our viewers are in the US. A lot of people are in Europe. Guess what? We're more advanced economies. We're more advanced demographics. People in our countries make tens of thousands of dollars per year. But imagine places like Africa, India, Southeast Asia. These are booming economies. And guess what? As economies get richer, as they grow, as they do more things, guess what they need? They need more of these commodities. So not only do we have supply going down, we have demand going up. Think about it this way. Ferrari builds 14,000 cars a year. But every year, more and more people become rich. In fact, Ferrari's fastest growing market is Africa, because Africa is one of the fastest growing wealth creators in the world. If all of a sudden Ferrari said, you know what? We're not going to sell 14,000 cars a year. We're going to sell 5,000 cars a year. Supply would plummet. Demand is still going up. What would happen to Ferrari's prices? They would go up even faster. So when supply goes down and gets tight and demand stays the same or goes up, prices will rise even faster. And when prices rise, especially at a faster rate, the companies that produce these materials will make a ton more money. The key here is you've got to look for well-managed companies in these sectors, or do what I did and buy ETFs that own the companies that do these items. Don't bet on the individual company, bet on the ETF. Opportunity number 2, guys. This has to be the biggest potential of all, and here's why. For the past several years, everyone has been obsessed with big tech companies. We have the Magnificent Seven, Apple, Google, Microsoft, Tesla, Meta. All these giants have sucked up all the attention. And guys, the performance has been very centered on these 7 companies. Meanwhile, smaller companies, and I'm not saying smaller S&P companies, I mean small cap businesses under $2 to $5, $10 billion. These companies have basically been ignored. The last time we saw this big gap between large and small companies was at around 2000. What happened after that? Guys, the S&P collapsed, the NASDAQ collapsed, and the small cap companies shined for nearly a decade. And here's the thing about small companies. When they're ignored, they trade for much less than they're actually worth. Why? Because not only are they ignored by the masses, but even the analysts don't follow them. It's like finding a house worth $300,000 that's selling for $150,000 or $200,000 just because it's in a neighborhood that no one's paying attention to. That's it. And guys, I believe that the next decade, the outperformers will be the stock pickers who are buying smaller companies, who work on individual small companies. Or, like I said before, you buy a small cap ETF based on value. Simply because at some point, when the money is leaving those large companies and looking for value, they're going to find it in small cap. And these are posed to have a long secular bull market since they've underperformed from the great financial crisis until now. Now, guys, I want to be clear. I don't necessarily mean exactly small cap companies. I just mean smaller companies in general. The smaller it is, the less likely it's to be included into an index, and the more likely to sit there and pay more attention to it. A company that I've had that's done very well was Sprouts Farmers Market. It's not a small cap business, but it was overlooked because it was smaller. These are the areas you need to go look for value. And now, guys, potential number 3. This one is something that I own a lot of, and not many people on this channel necessarily have paid much attention to it. But you need to understand why it's crucial. If you don't understand the difference between price and value and what's going on in the markets, you might miss the reason why there's a gap there. This price for value difference is the biggest mistake that I see new investors make. And I've probably said this 2,000 times in this channel. We have almost 3,000 videos, and it's so important, especially if you're new, but even if you're more advanced, to repeat this over and over. So the third opportunity is real estate. Now, I hope if you're new to the channel, you're like, real estate, man, interest rates are up so much from 3 years ago. Why would you want real estate now? For exactly that reason. Guys, I own 1,000 apartments upstairs. They're not literally physically upstairs. I'm just saying our office manages them and owns them. When the rates were 3-4%, it was impossible to get deals because everyone was chasing every single deal. Money was cheap. Guys, whenever money is easy to get or really cheap, that's where it's hard for real investors to do well. And when rates skyrocketed, that's what made it hard for the everyday investor who didn't know what they were doing to justify their returns. But when rates went higher, the smart money starts to make real money because it gets rid of all the junk, all the idiots out there who just made money because of low rates. I want you thinking that way, that when it's hard for everybody, it's opportunity for you. It's no coincidence that when rates skyrocketed, suddenly you're buying apartments and houses again. Why? Because all the bad money had to leave. All the people who were buying properties when rates were 3 or 4%, and now they're coming up on maybe some refinances, are having a tough time. But again, like everything in this world, it's price versus value. And of course, I use my real estate calculator here to determine my IRRs and making sure I understand that every investment I make is the present value of all the future cash flow I'm gonna get. So it's not that I'm just saying, oh, rates are high, let me go buy everything. I still need to analyze it. I analyze it in real estate calculator. For a stock, I analyze it in our stock analyzer tool. And guys, these are 2 tools, part of our entire package here, that's incredible. So if you want to change the way in which you invest, I highly encourage you to make sure that you do a few things. 1, surround yourself by like-minded people, because if you want to be great, you got to be around great thinkers. And 2, get yourself the tools you need to make better decisions. Spoiler alert, that's right here in our software. But, very important but here, if you're the kind of person who just wants people to hand you what stock to buy, we're not the channel for you. I'm surprised you even made it this far. But if you've made it this far, you're probably an independent thinker who wants to get better and learn. So join our community, get all the tools you need, be around thousands of like-minded investors, and it'll make you a better investor. So click the link below. We have a great 7-day trial, allows you to dip your toe in, see how beneficial this is, and it allows you to make better decisions. Now keep in mind, Whether it's stocks, whether it's real estate, whether it's commodities. People hear an exciting story and they get so caught up in the story they forget to ask, am I paying a reasonable price? The fifth tenet of our principle-driven investing, a great story can become a bad investment if you pay the wrong price. This is what I want you guys remembering. This is so important. Let's say you love Tesla, you love their cars. Let's say you love NVIDIA, you love their chip. Amazon, you use Amazon every single day. That's fine. That's great. But if you're just going out and buying the stock because you love the company, what you're basically saying is no price is too high. Because if you don't understand what's behind that price, what's the value behind that price, then you're going to be overpaying at some point, if not today. Let's use an extreme. Would you buy the entire Amazon company for $1? Well, of course you would. Would you buy it for $10 trillion? Probably not. How about $100 trillion? Probably not. How about $1 quadrillion? I hope you see my point here. There is a price that's too high. And all I'm trying to teach on this channel is a way of thinking to understand that and then having the tools to be able to determine the correct price. So Amazon, same company, same products, same future potential, but the wrong price makes it a bad investment. The right price makes it a great investment. Because Amazon as a company doesn't care what price you're paying. They're still on their path to making the company great. In 2000, it fell 95%. And their fundamentals just kept getting better. The market, Amazon did not care what the market was determining about the price. The market dropped the price 95%. Amazon's fundamentals got magnitudes better. Warren Buffett once said so eloquently, price is what you pay, value is what you get. Most people fall in love with a company's story and forget to do the math. The math doesn't care how much you like a company, just like the market doesn't care. If you overpay, you're not going to do well. But the great news is about great companies is they justify a premium. The question is how much of a premium? And here's a simple test I like to use that's kind of a variation of what Warren Buffett has said. If the company I bought today, the stock I bought today, the market shut down for 10 years, would I be okay owning it? Can this business survive? Will it get better for the next 10 years? If the answer to it is no, then I'm probably not going to be buying and I'm probably speculating. If the answer to it is yes, it's a great start to looking into the company. And one more important point, just because a stock price has fallen doesn't automatically make it a good value. Look at all the stocks from the 2000s. Look at all the EV vehicles that went to zero. They fell 80, 90 on their way to 100% fall. Just because they were 90% lower did not make them a good price. The example I'd give is, let's say you have a house that's worth $400,000 and just for fun, you ask $4 million for it. Great. Well, nobody buys it. Well, you drop the price 80%. Now it's $800,000. Is it a good deal now? No, it's still only worth $400,000. Zoom stock did exactly that. It fell 80% from its peak. That doesn't mean it became cheap, but it's a great place to start looking. You still need to understand the fundamentals and you still need to be able to compare the price to the value. You determine the value, the market will tell you the price, and you become a buyer, seller, holder of the company. And what's most important for all beginners, we're all human and we all make mistakes. The future is unpredictable, and that's why we need that margin of safety that we hear every value investor talk about. As an example, if you think a company is worth $100 per share and it's selling for $100, you might say, oh, this is a good value, but you might be wrong. So you need to have a margin of safety in there. How much? That's the art of investing. How well do you understand the company? How big is the company? How likely is it to survive? The more unknowns, the larger your margin of safety needs to be. You get rewarded investing, not by making brilliant decisions, by avoiding stupid ones and having a good process. Understanding price versus value keeps you from doing something extremely, extremely dumb. And by the way, guys, you're going to make mistakes. But if you do this on a portfolio of stocks, you're probably going to do well. Now, guys, there are those 5 tenets of principle-driven investing where I talked about one of them. Our community and myself, we live by these. These 5 tenets kind of act like guardrails. They help me make better decisions and reduce the number of costly mistakes I'm going to make. When I remind myself that, 1, we're investors, not speculators, it stops me from chasing hot stocks. It also reminds me when a stock is flying high that everyone else might be a speculator or trying to time the market based on emotion or hype. Second one, if I focus on the fact that every investment I make today, my returns can be determined on all the future cash flows it receives. It's the present value of all the cash it gets in the future. So for example, to make it simple, if I were to tell you I was going to give you $1 a year for the rest of your life, what would you be willing to pay for that today? Well, if you pay $1 for it, You're going to get your money back in 1 year and the rest is profit. Very high return. If you pay $10,000 for it, you're going to lose money because you're not going to live 10,000 years. And even if you're going to live 30 years, paying $30 for it, you don't do well because $30 over 30 years is not worth as much as $30 today. So between 1 and 30, there's the right number. It's about determining that. That's what's important. Third, if we don't understand it, we don't invest in it. Guys, you'll see us in the community and people say, Paul, how do you evaluate this bank or insurance company? I don't know. I don't understand them, so I'm out. I want to be able to explain how a company makes money, how it loses money, and how it can grow. If I don't understand that with banks, then I got to be out. Fourth tenet. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is, in the short run, stocks are going to go up and down. We have no idea how. But in the long run, their value is going to be determined. And I love talking about this with Cisco because Cisco was the NVIDIA of 2000. If you didn't own Cisco, you were stupid. This is going to be the first $1 trillion company. And guess what, guys? Hit a high of 82 back in 2000, has not gotten there yet. But what's interesting is if you take out this bubble, take out this euphoric time, guess what? From here to here, the price is up about 10x. Guess how much the profit's up? About 10x as well. Coincidence? No. And if you take out the bubble part, this looks like a pretty well-performing business. Now, I'm not telling you to buy Cisco, but my point is Cisco was the NVIDIA of decades ago. And I think NVIDIA is better than Cisco was here. But the point I'm trying to make is exactly that. In the short run, voting machine. In the long run, weighing machine. The fundamentals will drive the value in the long run. You've just got to be able to stomach the ups and downs in the market. This helps me ignore daily prices because it allows me to sit there and say, I don't care what the daily up and down is. What I care is the company going to be better 10, 20 years from now? And the final tenet, I told you guys before, a great story can become a bad investment if you pay the wrong price. This will really get you thinking. But of course, you need to understand how to analyze that. All of these tenets together, they force me to think logically rather than emotionally. It allows me to focus on facts rather than feelings and make decisions based on value rather than price and momentum. This is exactly how you avoid expensive mistakes that turn investing into gambling. So guys, if you want all of these principle-driven investment ideas, these tenets sent to you, click the link below. I'll email it to you absolutely free immediately. Keep it, read it daily. I'm not kidding. I go through these things every single day, and I've been doing this for 25, 30 years. So to recap the portfolio ideas, how do you apply all of this? Well, guys, if you're interested in these ideas, understand it. Look at it. See if it makes sense to you. And if it does, maybe dip your toe in with a small portion of your money. But remember, don't deviate from your dollar cost averaging into low cost ETFs. Whatever you do, make sure you understand what you're buying and why you're buying it. And guys, the biggest opportunities that I talk about may not come from the latest AI or meme stock that everyone else is talking about. And that's okay. They very, very well could come from these boring, overlooked sectors. But remember, opportunity without knowledge is just gambling. If you want to learn how to actually evaluate whether something is simply a good value or just cheap, you need to understand the fundamentals. So if you want to see how I apply this in real time, I actually did a video where I went exactly up against the Magnificent Seven because I sat there and said these things are overhyped and overpriced. I picked my own 7 stocks that I own back in January to go against the Magnificent Seven. And guess what? They're doing pretty well. In fact, they're outperforming. Major surprise to me. But again, I can't declare victory yet because it's been a short voting machine so far. But if you want to see what stocks those are, click the video on the screen to see my 7 stocks. Thank you for your time.